Insurance Exam Prep Understanding Insurance Contracts. Question 1. Which of the following describes a contract where only one party makes a legally enforceable promise? Bilateral, unilateral, aleatory, adhesion. In a unilateral contract, only the insurer makes a legally enforceable promise to pay covered claims. Question 2. Insurance contracts are considered aleatory because they are written by one party, they require mutual consent, there is an unequal exchange of value, they require utmost good faith. Aleatory contracts involve an unequal exchange of value or consideration. Question 3. A contract of adhesion is strictly interpreted against the insured, agent, insurer, state. Any ambiguities in a contract of adhesion are resolved in favor of the insured and against the insurer who drafted it. Question 4. What principle prevents an insurer from denying a claim due to a right it previously waived? Estoppel, indemnity, subrogation, concealment. Estoppel is the legal consequence of a waiver, preventing a party from asserting a right previously waived. Question 5. A statement guaranteed to be true is a representation, warranty, concealment, waiver. A warranty is a statement that is guaranteed to be entirely true. Question 6. If an applicant intentionally fails to disclose a material fact, this is known as fraud, misrepresentation, concealment, twisting. Concealment is the intentional withholding of material facts from the insurer. Question 7. The principle of indemnity is designed to prevent overinsurance, profiting from a loss, underinsurance, both A and B. Indemnity restores the insured to their original financial position, preventing profit and overinsurance. Question 8. Which element of a legal contract involves the payment of a premium? Consideration, legal purpose, competent parties, offer and acceptance. Consideration is the value given, which for the insured is the premium payment and truthful statements. Question 9. Who must have an insurable interest in the insured at the time of application? The beneficiary, the policy owner, the agent, the underwriter. The policy owner must have an insurable interest in the insured at the inception of the policy. Question 10. When an applicant submits an application with the initial premium, it is considered an acceptance, an offer, a counteroffer, a binder. Submitting an application with premium is an offer to the insurance company. Question 11. If an insurer issues a policy with amended terms, it constitutes a counteroffer, waiver, breach of contract, acceptance. A counteroffer occurs when the insurer alters the requested terms before issuing the policy. Question 12. Utmost good faith means both parties must not conceal material facts, use an attorney, file claims promptly, pay premiums annually. Utmost good faith expects both parties to act honestly and disclose all relevant facts. Question 13. A representation is a statement believed to be absolutely true, true to the best of one's knowledge, a legally binding guarantee, a material concealment. Representations are statements believed to be true to the best of the applicant's knowledge. Question 14. The transfer of a legal right or interest in an insurance policy is called assignment, subrogation, endorsement, estoppel. Assignment is the transfer of ownership rights in a policy to another party. Question 15. Which of the following makes a contract voidable? Fraud, consideration, mutual assent, legal purpose. Fraud or material misrepresentation can make an otherwise valid contract voidable by the insurer. Question 16. A policy is a conditional contract because it depends on uncertain events. Both parties must perform certain duties. It is drafted by the insurer. Only one party is bound. Conditional contracts require certain conditions to be met by the insured to trigger the insurer's duties. Question 17. What is the legal process that gives the insurer the right to seek recovery from a third party? Arbitration, appraisal, subrogation, estoppel. Subrogation transfers the right to recover damages from a third party to the insurer. Question 18. Which feature allows the insurer to cancel a policy due to unpaid premiums? Conditions, insuring clause, exclusions, declarations. The conditions section outlines the rights and duties of both parties, including premium payment terms. Question 19. Insurable interest must exist at what time in life insurance? Time of death, time of application, throughout the policy, at claim settlement. In life insurance, insurable interest is only required at the time of application. Question 20. Which part of the policy contains the insurer's promise to pay? Declarations, conditions, exclusions, insuring clause. The insuring clause or agreement contains the primary promise to pay the benefits.